Welcome to part 4 of Accounting the Basics, and we are going to today get to the rules of debits and credits. And where we left off, we've gone through a little bit of information here to get to this point, but we're finally at the rules. I've promised you rules for a couple of tutorials, and I had to give you some additional information before we actually got to those rules. But we are in a great spot to give you those rules. There's a nice little tool that's going to help you learn your debits and credits. And I can't emphasize enough that you really do need to learn after eating dinner, you really do need to learn these debits and these rules. Okay, so I got a little tool up here. After eating dinner, let's read comics. Okay, so I'm going to make a nice little line here for you so that you don't have to worry about my drawing. All right, after eating dinner, let's read comics. Now, if you look at this, it looks like kind of a lopsided one. All right, if you look at this, it looks like a big T account, where this is the left side, this is the right side, and of course it's built and designed this way. Okay, after eating dinner. So, all right, well, what does this mean, after eating dinner, let's read comics? It's just a way to help you memorize this stuff. All right, so A in after stands for assets. The E stands for expenses. The D stands for draw. L stands for liabilities. R stands for revenue. C stands for capital. And I know what you're thinking right now. You're thinking, yeah, Victor, in the last tutorial you gave us 5 categories, and I'm looking at this little tool you just draw and I see 6. What's going on here? Okay, that's because, remember I said these categories of accounts, that you can have a lot of accounts underneath each one of these categories. So assets, you're going to have a bunch of accounts. Expenses, you're going to have a bunch of accounts. Liabilities, you're going to have a bunch of accounts. Revenue, you're going to have a bunch of accounts. Notice I didn't do anything with draw, didn't do anything with capital. That's because capital only has 2 accounts. One is draw, and the other one is just capital, or typically it's, in a sole proprietor anyway, it's the name of the owner and capital. Okay, those are the only 2. There's no other accounts that fit under this category. And guess what? This is one, this is the other. Okay, so we have included all the categories plus the only 2 accounts that fall under this capital account. Okay? All right. Now, let me redraw this because I want to, so let's just redraw this. All right, so we got after eating dinner, let's read comics. Okay? All right, now you know what all that stands for. A is the assets, E is the expenses, D is the draw, L is the liabilities, R is the revenue, C is the capital. Now how's this going to help you? All right, well, here are the rules. All my asset accounts, my expense accounts, and this draw account, if you want to increase this, apply a debit. Conversely, If you want to decrease an asset account, an expense account, and a draw account, apply a credit. Okay, let's go over the right side. If I want to increase a liability account, a revenue account, or the capital account, apply a credit. Conversely, if I want to decrease a liability account, a revenue account, or the capital account, apply a debit. Those are your rules of debits and credits. Okay? Now, there's one other thing, and that is over here on this left side, the normal balance on these accounts is a debit. I'll explain in a minute. The normal balance over here on the right side of these accounts is a credit. Now, all this means, normal balance, because this is used a lot in accounting textbooks and so forth, all this means is that typically all these accounts that fall on the right, on the left side here, all my assets, expenses, and this draw account, they all should end up, they all normally should end up with a debit balance. All my accounts over here on this right side should normally end up with a credit balance. That doesn't mean that they will, because and it's okay if they don't. It's just normally that is the case. Okay, so those are your rules of debits and credits. Let's go through them again. When I want to increase, arrow up, increase an asset account, expense account, or the draw account, I need to debit that account. To decrease an expense account, to decrease an asset account, expense account, or the draw account, I need a credit. Okay, over here on the right side. To increase, arrow up, a liability account, a revenue account, the capital account, I need a credit. To decrease liability, revenue, capital, I need a debit. Okay, so now let's apply this. I'm going to put this back up, but I'm going to put it back up shorthand. So I'm going to do AED, LRC. Okay, and let's just draw a nice little line so that you don't have to worry about my writing. Okay, and now let's follow this through with a transaction to see how this works. All right, so again, after eating dinner, this is a D. Whew, I must have failed handwriting class or something. All right, after eating dinner, let's read comics. I certainly don't remember. Liabilities, revenue, capital. Okay, let's pay our rent on the office. Let's pay it today, and let's pay it $2,000 because that's what their rent is. Here's our transaction. We're going to record this transaction in these T accounts, and we're going to now apply the rules in a systematic fashion. All right? All right, step one. Step one is to determine which accounts are affected. So let's break this down. Pay. The word pay means cash. So we got one account. Also remember that every transaction I need a debit and I need a credit. For every transaction. This is every transaction. No exceptions. Every transaction I need a debit and a credit. I also need them to balance. Remember, those are my abbreviations, or the abbreviations, not mine. Debits equal credits for every transaction. So not only do I need a debit and a credit for every transaction, I need them to equal. And I mean equal. Whether it's $100 debit, I got to have $100 worth of credits. Okay? All right. Step one then. So I know I've got one account, but I know I need at least another account. I know I need at least one other account because I've got to have two here at least. I need a debit and a credit. I only have one. I don't know if that's a debit or a credit yet, but I know it's only one, so it's either a debit or a credit, right? So I need another one. All right, what am I paying? Well, I'm paying rent. Okay, so there's my other account. So I have cash and I have rent expense. I know it's an expense because remember I'm using that to generate revenue. And rent on a building is going to help generate revenue, so I know it's an expense. So there's my two accounts. Cash, rent expense. Okay, step two. Step two. Use AED, LRC to determine whether it's a debit or a credit and where that debit and credit is going to go. All right, so let's use a couple of T accounts. Okay, we know cash is one account. We know rent expense is the other. Question is, and I know it's 2,000, so I don't need to put that down anywhere. I know it's 2,000. So I know 2,000 is either going to go here, 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 or here, right? Okay, so let's see. The first thing you have to determine when you get to this point is where does the cash account fit with this AED LRC thing? So you have to ask yourself, all right, is cash a capital account? No. Revenue? No. Is it a liability? No. Is it a draw? No. Is it an expense? No. It's an asset, right? Okay. So, then ask yourself, am I increasing this account or decreasing this account? Because remember the rule. To increase any one of these three, I need a debit. Therefore, to decrease any one of these, I need a credit. Same thing over here. To increase, I need a credit. To decrease, I need a debit. Okay. So ask yourself, am I increasing this account or decreasing it? Well, if I'm paying it, I'm decreasing it, right? Okay. Well, so we know cash is an asset. We know we're decreasing it. Therefore, it's a credit. Credit's on the right side. So there's my 2,000. The 2,000 credit to cash. Now, I could stop here. I could stop here and I could say, okay, you know what, Victor, you just said that I need a debit and a credit, right? And you also said that my debits have to equal my credits, right? Okay, if these are the only two accounts affected, cash and rent expense, then do I need to go any further with this rule? Or will I know that this is here? And I know that this is here because this is a debit. And I know that my debit, I know this is a debit. So I know that my debits, 2,000, have to equal my credits of 2,000. I know I'm done at this point because my debits equal credits for every transaction. Here's the credit, here's the debit, I'm done. Okay, but let's see if I was right. Let's make sure I didn't make a mistake. All right, rent expense is easy. We already knew it was an expense. It falls right under the same spot here, AED. Ask yourself, is rent expense increasing or decreasing? And it's increasing because the more the rent I pay, the larger this number is going to get, right? I mean, if I pay rent again next month, isn't this thing getting larger? And of course it is. Okay, so I know it's increasing. So again, increase and expense is a debit. There's my debit. Decrease an asset, credit. There's my credit. Okay? All right, those are the rules of debits and credits. And we will do some more next part. See you then. Bye.